What's going on, guys? Welcome back to another episode of the Real Estate Investing Q&A show. It's been a little while since I've recorded one. My hair's been getting longer if you didn't notice, but been a lot of stuff going on. Had to put some things on hold. We're writing contract now for 3 brand new deals, 2 in Jacksonville, 1 in Columbus, about 500 units. See the board behind me a little bit off to the right, which is keeping track and all that stuff. So been too long since I've done it. I probably posted, another one that I've had in reserve for a while. But we've been staying busy. We're raising about $10 million across 3 deals, also in contract to sell one. So a lot of stuff going on. Been trying to keep up with a lot of the social media and, all this fun stuff, but had to take a step back, but I'm trying to get back more into it, trying to, systematize and do everything better. So that's us. Just trying to change up the views a little bit. You can see the office behind me. It's like 7:30 at night doing this. But just wanted to hop on, answer some more questions, give you guys some more valuable stuff, and create some more content. But I'm going to dive right into the questions. So without ado, question number 1. Hello, my name is Logan McGill, 6-year-old living in Massachusetts. This community has a reputation for being helpful and kind, so I thought I'd ask some advice. I want to be involved in investing when I'm older, starting out with wholesaling and then working my way up to buying. Fortunately, I can't start that until I'm 18 years old. That got me thinking, what can I do in the meantime that will A, make me money for investing in the future, and B, get me some experience in the real estate world? I can't sign contracts, but maybe I don't need to. So here's my idea. Build my network of agents and investors, and then charge the investors to find them a property within their requirements, and I could possibly charge real estate agents for helping them sell their clients' property faster, thus making them their money faster. I'd like to know the opinions of people knowledgeable in the real estate world. I would be grateful for any feedback, constructive criticism. Please don't hold anything back. I know there's probably already things a viable option for someone in my position. Would those be willing to pay more for that service? How much should I charge? Thanks. So first off, awesome that you are 16 and trying to get into real estate. I wish I knew about it when I was 16. I didn't really start learning about it until I'm 24. I'm 27, almost 28. So kudos to you. Always tough to kind of make your way in. First thing I'll say, I really think you should consider working for somebody for free for a little while to gain a broader knowledge. If you're 16 and didn't mention anything about, needing the money for anything today, just really trying to make money. If you don't need to make extra money, if you're 16, you still have parents supporting you, I think making some money is great, but getting that knowledge and that base from somebody who has experience is way more valuable. So if you can go work for an investor, an agent, an owner, a manager, a professional for a year, 2 years, 3 years, 5 years, that's going to be way more valuable than trying to go out and do it yourself and pick up little things here and there and trying to make some money today. I think in 20 years from now, your ROI on that 2 or 5 year free working period or 6-month working period is going to be way better than starting a business there that you're eventually going to transition out of. But if you were stuck on, hey, I want to earn money now, I want to, see how I can be helpful to people, I think you have a close to good idea. I think you can't find deals that are listed with agents to sell to investors because I think you're not providing a valuable enough service, because as soon as somebody's starting to look in that area, any deal on the market they can find listed. So it's not really a hugely valuable service. It's the same thing when people are looking to bring us deals. A deal that's listed is not valuable. I can go out and find that deal for 98% of the time if I wanted to in certain areas. The way you can bring somebody value that is looking for deals is to find deals they can't find. So that's off-market. The way you find off-market deals, getting in direct contact with those owners, whether it's cold calling, direct mail, knocking on doors, driving for dollars, different creative ways, SEO marketing, Facebook advertising, different other mediums of advertising, bandit signs on the lawns, call me, buy your homes cash, quick, whatever. Those are all valuable ways. If you can bring me a deal that I would not have found without you, that is incredibly valuable. You will get paid 10 times out of 10. I guarantee it. Assuming property is worth what you're bringing it to. If it's overpriced, deal's not going to close. But assuming that deal closes, you will get paid. So if you were stuck on, hey, I want to help out somebody and invest from the investor side, I would definitely look to try to find direct to owner ways to get involved. And if you talk to an experienced owner, this is going back to getting paid for free. If you said, hey, I'll come in and do your grunt work for free, or minimum wage, or don't pay me until the first deal closes, that's a great way to do it. And you got a buyer line up, you know exactly what they're looking for instead of trying to guess. Or you go out, find the deal, and then also you got to create the buyer's list as well. So there's a lot of moving parts. If you're going direct to owner, I still think finding that experienced person to then find and do the grunt work for them, and then working out a payment scheme, or even just working for free, I think is an easier step into it, an easier segue, because you can always break off onto your own in a year or 2 years. I think that would be a really great way. If you wanted to help agents, I don't know how much you could do without becoming an employee. And in a lot of areas, I don't know Massachusetts, a lot of areas at 16 you can get a job with a guardian or parent signature. You could probably do a lot of their work and get paid, or get paid by commission or whatever. So if you were, if you wanted to work on the agent side, I think you would go more the traditional route. But investors, way more likely to get creative and to come up with different structures and roles and responsibilities to help get your foot in the door. I think another valuable thing, and I'm going to go off on a little bit of a segue and a tangent. This is not just for the 16-year-old, but this is for anybody trying to get into real estate, is still work for somebody for free, but try to find something that and can already do that can be valuable to somebody else. So my first thought with a 16-year-old is technology, right? If you can find the investor that's 40, 50, 60 years old, maybe even 30, and they just have no technology background, maybe they need a website redesign, maybe they need email marketing, maybe they need Facebook advertising, maybe they need social media work. There's tons of stuff through technology, I could probably go on forever, that they don't know how to implement, but maybe second nature to you because you grew up in the technology space. And we're seeing that more and more. And I think trying to find a more creative solution to get your foot in the door and learn from them, if you can provide a service for somebody, doing something you already know is probably going to be significantly easier than trying to learn something to then provide that service. So learn how to get in touch with owners and then do it for somebody. That person, a real estate investor, probably already knows how to get in touch with owners and is either doing it or is not doing it for a certain reason, whether it's capital, time, etc. But maybe they know they can get in touch with owners if they can do social media marketing within a 2-mile radius, but they have no idea how Facebook works. They have no idea how to do advertising. They have no idea how to set that up, nor do they have the time. You can come in and implement that. That's going to be hugely valuable. I guarantee, especially if you offer to do it for free, they will take the time to sit down with you and help you learn the business, get involved, maybe give you parts of the deals, and probably pay you if you do a good enough job. Even though you work for free, a lot of people will probably pay you for your time. So my advice to sum it up is I would seriously consider working for free. I would seriously consider finding somebody to work with and learn off of. I would really consider working with investors more than agents, and I would try to find a niche you already know to offer to somebody that may or may not, that already probably needs that service, whether they realize it or not. But next question. Hey everyone, quick question. Want to see how everyone decides where they're going to invest. Close to home, price. I'm looking in a few different areas. I'm looking to really narrow down my search. So when you are looking for an area to invest in, I think you need to understand what you're personally looking for and then back into those areas. So this is a common topic we've had with our meetup groups, and the reason being is New York is not an easy place to invest. Places like New York, LA, Bay Area, Miami, they're very focused on low cash flow, high appreciation, which a lot of people aren't looking for. So they start thinking about out of area, out of state, things like that. So when we talk about finding markets or neighborhoods, the same principles apply whether it's the 5 neighborhoods around you or 5 markets that are a 5-hour flight away. You got to back into what you're looking for. Are you looking for appreciation? Are you looking for cash flow? Are you looking for more upside with more risk, or more conservatism and less upside? Are you looking to use debt or not use debt? Are you looking to be in flips, rentals, self-storage, industrial, triple net? All these things come into factor, And until you really understand what you're trying to achieve, you can't start to eliminate all the possibilities. So when you're looking at a market specifically, a lot of things you need to account for are what are the economic indicators, what are the demographic indicators. Are you looking for the top 5 markets in the country by population, despite what's going on? Or are you looking for really high growth areas? Or are you looking for not so much growth areas and better yields going in? So like cap rates or cash flow, etc. And you're just looking for steady eddy. Another thing you need to consider is where these markets are and what's in the markets. For example, if I have 2 deals, all things being equal, one in Mobile, Alabama, and one in Charleston, South Carolina, I'm choosing the Charleston deal every time. It's a direct flight. It's a way better area, so much more to do, and it's on the water in really nice beaches. Mobile's on the water, but not really nice beaches. Sorry for anybody who lives in Mobile, but that's just what I prefer. Even if the deal is double the return in Mobile, I may still choose Charleston because I prefer that area significantly more. Other things to consider is, where's your family? If you buy real estate where family is, you can probably write off those trips if you have a company or an LLC and combine it with going to see family and going to do real estate. I think you only need 50% of the time for real estate to be able to write it off for that business or the business trip, whatever. Now you're killing 2 birds with 1 stone. Also, you got people in the area to check in on it if shit hits the fan or just want somebody to drive by or help out or meet somebody there. Also, are there areas you go on vacation a lot? Again, same thing. You're going to those places. Probably like those places. You continue to invest in them and you're killing 2 birds with 1 stone. Or friends, just other people. If there's reasons to go to a place, it might be worth looking into. Also, you may not want to travel all the way to the West Coast and deal with jet lag or extended times. I live on the East Coast, so from East Coast to West Coast, do you really want to take a 5-hour plane ride or whatever it is to Phoenix, Arizona to go invest, or Nevada or Idaho, or would you rather invest in the Midwest or the Southeast or the tri-state area if you don't want to go that far? Other things to consider: do you like flying? Do you like driving? I don't like to drive more than 2 hours because I just get bored and I don't like it. I was talking with Michael Zuber, one rental at a time. He didn't want to fly because he spent, dozens of hours every week flying for work and he was sick of airports. So he said, I'd rather drive 3 hours to Fresno from, I think he said LA or the Bay Area, and do that, where I did not want to do that. So very different takes. Neither one is right or wrong. It depends on your life experiences. I'd much rather fly 3 hours than drive 2 hours because I find the flights better and more enjoyable than the drive. So there's a lot more to going into a market than just, is it growing? Is it, low population, low unemployment, are jobs going there? Yes, you always want to see that, but there's other things that go into it and what you're looking to accomplish. Next question. I've identified an apartment complex close to one of my properties in Louisville that is in really bad shape and want to try to buy it. How do I find out who the owner is and get a hold of them? So discounting paid websites like Reonomy, CoStar, Yardi, etc. There's tons of ones you can buy to try to get into. I would look first on the county website, whether it's the appraiser or the tax assessor, and a lot of times they'll list the owner. For smaller properties, single families, condos, duplexes, small multifamily, a lot of times people do it in their own name and not in an LLC. Sometimes there's even a mailing address. Sometimes there's even a phone number. There you go. Probably right there. Also depends on if your state is a disclosure state, non-disclosure state, stuff like that. If it's an LLC, just Google the LLC. You could probably find the name attached to it, especially if they have to register the LLC. Again, it's state by state. And then just start calling numbers that are there. And then if not, I would, if there's a property management, a lot of times the apartment complex or the rental will have a number attached to it, especially if it's an active rental. Call the number, ask who the owner is, ask if you can get in touch, ask if you can leave your information, see what we can do. Things like that. If you're local, drive for dollars, knock on doors, ask local places around there. You never know what you might find. So the county website is usually a really good one. There's tons of paid resources that you can go to, numerous ones. I'm not going to even do it. There's also lists you can buy a lot of times that have the information sourced out for you. But if you were dead set on doing it free, place I would start with is the county website or the appraiser's office and go from there. I don't know too many beyond that though. So next question. Currently have 39 units, about half multifamily, half single family, I'm assuming. Debated whether to consider trading up to larger multifamily properties, good idea or bad. How would you time the sale of multiple other units to purchase a larger unit if you think this is a good idea? Thanks. So I think this is a common theme for a lot of people that have been acquiring rentals slowly over time and have a small portfolio now of, similar to this person, single families or small multifamilies, is should I sell and upgrade into larger stuff? I think yes, with the caveat of I don't think it's a good idea to sell your whole portfolio and buy one or two larger properties. The reason being is, one, it's going to be a different type of property. It's going to have some sort of a learning curve for you to understand how to do it. So you don't want to put all your eggs in one basket. Two, I just think for diversification purposes, you want to hold on to some of your single family or small multifamily so you're not into one or two properties. Three, I think, like he mentioned, offloading 39 properties isn't going to happen overnight unless you sell it to one buyer, and you might have to offer a discount for that. And maybe you even get a premium. It depends on who you can find for the buyer, but if you're not going to sell it at once, it's going to take time. So if you have to, let's say it takes 12 months to sell 39 properties, which is probably a lot because that's 3 a month. Let's say 24. I think that's more realistic, to be honest. Let's say it takes you 2 years. So now that first property you sell, what are you going to do with that money for 2 years? I think he even said, what should I do? I don't know that there's a good answer. So unless you can sell those properties and buy into 4, 5, or 6 larger ones, which I don't know. I don't know if I'd call them larger. It's probably thinking of selling and going into 1 or 2, larger 50, 100 unit properties, if I had to guess. Now you've got cash sitting there on the sidelines for a while. So for me, I'd be almost more inclined to sell a third or half of the portfolio, roll that into 1 or 2 larger properties. You still have, maybe even 2/3, but you still have that other stuff. It's not going to take you nearly as long to sell, and you're going to get your feet wet with the larger properties. You can figure out, there's plenty of people that don't like the larger stuff. There's plenty of people that like the smaller stuff. I just happen to prefer the larger stuff. I think it's better in the long term. But be that as it may, you don't know. Going back to, we were just talking with the markets for personal stuff, you may not like that, and you're not going to know necessarily until you try. And if all of a sudden you're now just in one large property and you don't like it, and God forbid you hate it, it's going to be terrible, and you're going to think it's going to be the worst decision. So I think there's something to be said for moving into it slowly and building it up over time. I think if you tried it slowly, let's say you sold a half of your portfolio in 6 to 12 months, rolled into a larger multifamily, let's call it 50 units for argument's sake, and you found out that it was the best decision you ever made, I think in 15 years from now, if it took you an extra year to roll into a second 50-unit property, or let's say 2 30 units, or 2 25 units, or 2 40 units, whatever you can get, I don't think 15 years from now you're going to say, fuck, I wish I would have done it instantly. I think you'll probably say, considering what I knew at the time, it was the right decision not to take that leap and put everything into it. Hindsight, maybe you could have, and it would have worked out better, but I don't think it was a bad decision there. So I think there's something to be said for taking it a little bit slower, not offloading your entire portfolio, making sure it's something you really want to go into before you dive in head first. Next question. Looking to get into real estate but don't know what way to head. I'm 22 years old living in San Diego with a good job, currently building credit and have a good amount of money saved. I keep saving but don't know where to invest my money. So similar question to the 16-year-old, but different because he's got a job making good money and wants to invest. My kind of go-to advice when this comes up is, one, you've got to understand what you want to accomplish. with your money. Are you risk averse, or are you willing to take on risk? Are you looking for cash flow to supplement your income, or are you looking for appreciation to continue to build your equity, your nest egg, whatever you want to call it? Then you've got to learn about the different asset classes and what they offer, the risk and reward profiles. You've got to look at markets. You've got to look at, do you want to do it passively or actively? There's a million different questions you have to answer, but you have to understand what you want to get out of it before you can start deciding what to invest in. And oftentimes I find that when people are asking this question, they don't yet know what they want, and that's fine. There's nothing wrong with it. I think at some point, though, you have to get close to what you want to do. Maybe it's not the perfect thing, but you've got to at least try something. So start to figure out, you're going to know right off the bat, there's things you definitely don't want to do. For example, you probably don't want to build ground up construction 200 unit multifamily in the middle of nowhere, West Virginia. So nobody wants to do that, but you can take that off the table. But you can slowly build that up. Maybe you have no construction background, probably not going to build brand new Class A multifamily properties. If you've got no self-storage knowledge, you're probably not going to build self-storage. You're probably not going to build anything if you don't have a construction background, especially on your own. So you can take that out. Maybe you don't feel comfortable doing flips because you don't have the construction background. So take that off the table. Maybe you hate cold calling and dealing with owners. So you can take off, wholesaling and flipping, because probably not going to do it through the MLS. Maybe you are really, really looking for cash flow and you're really looking to supplement your income. You could probably take off certain markets off your plate, like the top 10 to 15 MSAs. You may even want to take out certain asset classes like Class A multifamily, Class B multifamily, because you're not going to get a ton of cash flow. Maybe you decide, all right, now I'm starting to think about, okay, self-storage, mobile home parks, triple net leases, things that are providing steady, reliable, higher cash flow. And you've whittled that down from 50 down to 5, and then you say, okay, pick one, try it, and go for it. That's how I got into it. It was started with flipping, tried it for 7 or 8 months, liked it but couldn't put it together, so decided to change, tried buying tax deeds down in Philadelphia at auction and hated it immediately despite thinking I would like it, and moved on quickly into small multifamily, really liked that, but saw that large multifamily was even better, so then moved on to large multifamily, and that's where I've been for the last 3.5 years. And we're starting to segue into different things like the mobile home space, some land stuff, things like that. So even though you get into one, you can still add things on top of it. But it took me technically 4 different types of real estate investing before I finally figured out which one was right for me. And it took time and it took money. I'm not going to sit here and tell you that you're going to figure it out super quick and it's going to be free. It may well take your resources to go down slightly before you start to increase them, whether it's time or money, before you figure it out. But you got to whittle it down to as little as you can, and then you just got to pick one and try. The longer you try to figure it out, once you get down to that 5 or that 3, and you try to figure out which one is slightly better, you're not going to know until you're in it, and you're just delaying the inevitable. So you might as well just pick one, go for it, and figure it out quicker, sooner rather than later. Next question. I've been thinking about getting into real estate investing. Syndication sound appealing since I've heard it's more passive than typical real estate investing, as I could just hire a manager that has way more experience than what I have, possibly get higher returns investing in expensive commercial real estate instead of just single family homes or whatever. From what I've gathered, index funds usually return around 7% on average each year. From what I gathered about investing in syndications as a limited partner, it's typical to get around 15% annualized total returns. Is this a reasonable return? But since being a limited partner would involve a lot more time and effort than index funds, as you would have to find the syndicator, choose what city to invest in, neighborhood, etc., how is this better than just sticking to index funds? So to quickly address one of the questions, a 15% annualized return for multifamily syndications is definitely a realistic expectation. That's what a lot of investors are looking for on returns. It will change based on asset class. Class A and Class B, major metropolitans like New York, LA, Miami, that could drop down. It also depends on the type of business plan. If it's more redevelopment or more heavy lifting deals, distressed deals, that would probably be higher. But 15%, good middle ground. You're probably okay with that. In terms of talking about publicly traded index funds versus syndications, I think there's a lot of differences between the two and nuances that need to be understood and figuring out which is right for you. The first thing I'm going to address is the last question, is the time required to pick a fund and a syndication. I think the time requirement is more similar than you think, because if you're looking at different funds, you should be spending the time to understand exactly what they're investing in, what they're buying, what their philosophy is, where they're buying, types of deals, all that stuff. The same stuff you would find as you interview different syndicators. So I think that time requirement is probably the same, or should be the same. I think the only difference may be in the ability to find the funds versus the ability to find syndicators. These funds are listed on publicly traded stock exchanges. Just go on, Yahoo Finance, you can find all the different funds, and then you start researching them. Syndicators, because it's all private, are often harder to find, and there could be many that you don't even know exist. So I think that time requirement, yes, I could see is higher. In terms of comparing a publicly traded index fund versus a private syndication, they are very different in a lot of ways. I think, first off, the liquidity aspect of it. A publicly traded index fund is a liquid investment. You can call up your brokerage account or your broker and say, hey, or now everything's online, say, hey, I want my funds back. I want to sell and get out. And I think you get it back within 24, 48, 36 hours, whatever it is. A syndication that is not in a fund structure or in a liquid fund structure is an illiquid investment. That means if an investor in one of our deals calls me up and say, hey, I want my money back, I'll say, okay, let's see what we can do. And if he says, but I want it now, I'll say, tough shit. You signed an agreement. You knew this was an illiquid investment. This is probably going to take a few to several months, if possible, because what I have to do is sell your interests in the property or the LLC that owns the property to somebody else. So a lot of times we'll try to help find people that are interested, but there's no guarantee that a deal is going to be done. Same way as when you buy a real estate property, it takes time and evaluation and an offer and a closing and getting funds together. So it may take, a month, 2 months, 3 months just to find the people, get them the information on the property, figure out what you want to sell for, what they want to buy for, negotiate, get an agreement in place, get the funds together, and then actually transfer. It could take a while, and a lot of times it doesn't even happen, because just the nature of it is, if somebody says they want to sell their interest, it's almost guaranteed that they need that money for a very good reason and are a motivated seller. So just like any motivated seller, a buyer is going to not offer probably full value, because a motivated seller's value is less than just a regular seller. So you may not even get all your initial investment back. If the investment value is way up, you're probably not going to get full market value, because you need the money back. This isn't just a standard regular transaction. It's the same way as when you see stocks that have very low trading volume. It's way more volatile up and down, because there is a buy and there's an ask, and until one of those two are met, a trade doesn't happen. So this is even way less than that. I mean, those happen thousands, 100,000 times a day. This hasn't even happened once this year. Nobody's called us up. Actually, no, I lied. There's one investor who would like to be bought out. It's been 6 months. He hasn't been able to have it happen. So that's what happens. So biggest difference is liquidity. So the index funds, major pro. The syndications is a con, illiquid. One of the pros of being a syndication investor is they are structured as, well, an index fund, you are a shareholder in that fund. You don't technically own real estate. You own shares of the fund that owns real estate as it's traded publicly. For the syndications, you still own shares of the company that owns the property, but those corporations are set up as an LLC, which passes all the benefits through. So that's depreciation, that's write-offs, that's direct ownership of property. So if you ever ask for a SEO, not SEO, PFS, like a personal financial statement, or real estate owned REO, real estate owned schedule, you can list those on there because you are a percentage of the ownership of that property. If you own a publicly traded fund, you can't put that. So you get all the benefits of direct ownership of that property, just like if you went out and bought a single family home for yourself to rent out. Same thing. You're just a certain percentage, 2%, 5%, 1%, 10%, 30%, whatever. So you get that benefit of it. Also, the property pays out the cash flow and sale is usually the way syndications are set up. I believe funds are typically just cash flow, which is why you're in the 7%-ish range. Typically what cash flow is on properties. When a syndication of 15% annualized, of that 15, 6-7% is cash flow every year. The rest is made up upon sale, just annualized out. So if it was 3 years, you would take the sale, divide by 3, and add that to the cash flow per year. So I think there's pros and cons. Those are two of the biggest ones that I see. There's more subtle ones as well, but those are the biggest differences. Oh, and that's the last question. Cool. So I went with Biggerpockets this time. It was just easier to find. I also thought I'd get a little bit more variety. I'll probably use some more questions from Instagram going forward. But if you like this episode, it'd be awesome if you would like it, comment, subscribe to the channel. If you got any questions you want to see in further episodes, you can drop it in the comments below. You can hit me up on Instagram at chris.grenzig. But yeah, that's my show. Thanks for watching.